The Federal Reserve had its big meeting this week. As expected, the Fed kept its main interest rate unchanged, its fourth straight pause. Markets barely reacted, showing investors had already priced in this decision. No new programs or quantitative easing were announced, signaling the Fed isn't rushing to support the economy further. But the real story was in the details that followed. After the meeting, Fed Chair Jerome Powell held a press conference. These press conferences often reveal subtle clues about future Fed moves. Investors listened closely to Powell's words, searching for hints about what's next. The new economic projections and Powell's tone suggested a more complex, uncertain outlook. The Fed is facing more challenges and uncertainty than just a few months ago. This uncertainty is now the key to understanding what comes next. The initial calm in the markets was just the beginning. Investors are now analyzing every word and projection for deeper meaning. The Fed's steady hand on rates masks a growing sense of caution beneath the surface. The real news isn't the unchanged rate, it's the Fed's growing uncertainty. The next moves will depend on how this uncertainty plays out. For now, the Fed is signaling patience and watchfulness. The story is far from over. After the announcement, Jerome Powell's press conference took center stage. While the official statement was expected, Powell's answers gave insight into the Fed's mindset. He made it clear, the Fed is in a holding pattern, waiting for more data before making any big moves. Powell hinted that by the end of summer, the Fed would have a clearer sense of direction. This was a signal. Don't expect major policy changes in the next couple of months. The Fed is improvising, adapting to new information as it comes in. Powell admitted the economic data has been confusing, with mixed signals on growth and inflation. This is a shift from the Fed's past confidence. Now they're openly acknowledging uncertainty. The Fed is not on autopilot, it's actively reassessing its stance. Powell's careful language managed expectations, warning that the Fed's view could change quickly as new data arrives. Investors should be ready for the Fed to pivot if the numbers demand it. The message flexibility is the new strategy. The Fed is watching, waiting, and ready to react. This approach means policy could shift rapidly if the economic picture changes. Powell's humility is itself a signal. Uncertainty is the new normal. The Fed's next steps will be data-driven, not predetermined. For now, patience and adaptability are the watchwords. The market should expect surprises as the Fed navigates this tricky landscape. The press conference revealed more than the official statement ever could. The Fed's path forward is anything but certain. Tariffs dominated Powell's press conference. The Fed is worried. Tariffs create uncertainty and complicate its job. Tariffs push prices up, fueling inflation, and can slow economic growth. This is a tough spot for the Fed. Fighting inflation could weaken the economy further. Powell made it clear. They're waiting to see the real impact of any new tariffs before acting. The Fed won't react to threats or headlines, only to hard data. Higher prices and slower growth are both possible, but the Fed needs evidence. Until then, they're staying on the sidelines. The ball is in the government's court on trade policy. The Fed's patient approach signals caution in the face of policy uncertainty. Tariffs are now a top concern for the central bank. The Fed's next move depends on how this trade story unfolds. Powell's message was clear. By the end of summer, we'll know a lot more. This wasn't accidental, it was a signal to be patient. The Fed is pausing major decisions, waiting for more data. They're watching inflation closely, needing several months of improvement before acting. The job market and economic growth are also under scrutiny. Weakness in jobs or growth could push the Fed to cut rates, but they won't rush. The wait-and-see approach is about avoiding mistakes. Cutting too soon risks inflation, waiting too long risks recession. By stalling for time, the Fed hopes for a clearer picture by September. It's a balancing act. Don't move too fast, don't move too slow. Investors, businesses, and consumers are all in a holding pattern. The Fed's patience is strategic, not passive. The next few months are critical for gathering evidence. September could bring the clarity the Fed needs. The Fed's updated economic projections paint a more cautious picture. Inflation forecasts for 2025 are up, now at 3% higher than before. This signals the Fed sees inflation as stickier than hoped. Growth forecasts are down. GDP is expected to rise just 1.4% in 2025. The Fed sees the economy losing momentum, possibly from past rate hikes and tariff uncertainty. Unemployment is expected to rise to 4.5%, a sign the job market may cool. The Fed still hopes for a soft landing, but the path is narrowing. Higher inflation, slower growth, and rising unemployment mean more headwinds ahead. The projections show the Fed's growing concern about persistent challenges. The fight against inflation isn't over and growth risks are rising. The Fed's outlook is more cautious than just a few months ago. These numbers set the stage for tough decisions ahead. The economic road ahead looks bumpier. Powell highlighted a new risk: Middle East tensions and their impact on oil prices. An oil shock could drive inflation higher and hit consumers hard. Rising energy costs would ripple through the economy, raising prices for everything. This would complicate the Fed's inflation fight and could force them to keep rates high. Geopolitical risks are now front and center in the Fed's thinking. An oil price surge is unpredictable and could change the economic outlook overnight. Powell's public mention of this risk prepares markets for sudden policy shifts. The Fed is watching global events as closely as domestic data. A conflict far away can have immediate effects at home. The Fed's caution is partly about these unpredictable global shocks. Investors should be alert to how geopolitics could reshape the Fed's plans. The next big move might come from outside the US. The Fed is ready to adapt if global risks materialize. The Fed's dot plot reveals growing division among policymakers. More officials now expect no rate cuts this year, 7 out of 19, up from 4. This shift shows rising caution and a more intense internal debate. The majority still see at least one cut, but consensus is slipping. The bar for action is higher. Clear evidence of a slowdown is needed for cuts. This internal split means the Fed will move slowly and deliberately. Investors should not expect quick pivots. Policy will be data-driven. The debate inside the Fed is now a key market driver. The outcome depends on how the data unfolds this summer. The Fed's actions are not set in stone, they'll react to the evidence. The path of rates will be determined by which side, hawks or doves, wins the argument. Expect a reactive, not proactive, central bank. What does all this mean for investors and Bitcoin holders? The Fed's wait-and-see stance means more uncertainty and likely sideways markets. For riskier assets like Bitcoin, this environment is challenging. Big moves are less likely without a clear catalyst. High rates and Fed caution make investors more risk-averse. Bitcoin and other risk assets may trade in a tight range until new data or events emerge. The next catalyst could be a surprise inflation report or a major geopolitical event. Until then, expect choppy, directionless markets. Smart investors will focus on inflation and global risks, not just Fed headlines. Flexibility and caution are key. Don't bet everything on one outcome. The Fed is waiting for clarity, and so should investors. The next few months are about watching, not rushing. Stay nimble as the story unfolds. As summer unfolds, the Fed is watching the data closely, and so should you. The key signals: inflation reports, jobs data, and global events like oil prices and tariffs. The Fed needs to see a clear trend of cooling inflation before considering rate cuts. A strong job market gives the Fed confidence to hold rates. Weakness could force action. GDP reports will also be crucial. Any sharp slowdown could change the Fed's plans. Watch for surprises in oil prices or new tariffs, as these could quickly shift the outlook. The next 2 to 3 months will be critical for shaping the rest of the year. The September Fed meeting is the likely inflection point. Investors should track the same data the Fed is watching. The path forward depends on how these signals evolve. The summer is a period of waiting, watching, and preparing for change. The Fed's next move will be driven by the evidence. Stay alert, the story is still being written.